Hey, this is Sasha, and welcome to episode number 109, where I'm going to discuss and share with you some political risks as well as looking at some uncertainty in the market conditions. We'll talk a little bit about some stock charts here currently, such as like Starbucks, Apple, Amazon, Netflix, Facebook. So I'll share with you a few quick charts, as well as some news and announcements, and we'll just take a look at what you can do when there's uncertainty on the table in the market and what the market is currently doing. Now, before we get going and taking a look at some of the charts, remember that trading involves a lot of financial risks, especially if you don't know what you're doing. So all the videos, the topics, the strategies that we discuss in any of these videos, including this one, is just strictly for informational and educational purposes. It's there to give you some insight. And that is also because you might be watching this video at some time in the future and prices may have changed. So it's important for you to contact your local personal financial advisor before investing or trading in anything that I personally discuss. I think most of you understand that by now, but I just wanted to make sure and be clear about that up front. All right, so a couple of quick news and announcements before we get going into the lesson. Basically, the options course preview is available. If you've missed that from last week, that announcement, you can take a look at that, and I will share with you some sample lessons from that course. So if you go to the Rise to Learn website and then you scroll down, there's the Options Mastery, Business of Options and Trading Verticals. So if you go there, the video is really long. It's about an hour and 12 minutes, but it's going to share with you sample video lessons directly from the course. So if you go there, you can skim through the video and watch it all the way through. There's actual real sample footage right from the course where it'll give you some ideas and insights about the course. Course is massive. Again, we have it on sale and promotion for $349 right now. That sale will end right at the election day. So remember that right now it's on sale, it's on special, and after the election, it's going to end right there. Sale ends on the course on November 8th, 2016. So November 7th, make sure you purchase it if you're interested in the course. The other thing that I'm looking to do is the critical charts and videos were also posted. So if you go to the TRADERSFLY website, you can see I've done a couple of videos recently just to get a little bit of a hang of doing some video recaps on the charts. But what we will probably do is create more of a live-based seminar or webinar series for these videos as well. So that way, as I do the charts, you can also ask me questions. It might only be once a month for just getting started to see how people are interested in it, or if you're serious about looking at videos, or if you can attend. So we're going to play with some things here shortly with the critical charts, and we'll probably create a video-based package or just a regular picture-based package, because some people just want the pictures, other people want the videos, or both. So we'll look into that, and the longer that you've been a member, the bigger the discount I will probably do on the upgraded membership there. So those are kind of the main things really that have been in progress and that we're really working on as far as what's been going on here with me. All right, so now if we start looking at the markets themselves and we start looking and evaluating the charts, I'm going to go through some charts real quickly first, and then I'll give you some insights to the markets, because really it's about preparing for the uncertainty. We have the election coming up. Wherever you stand really doesn't matter to me. It comes down to what's possible, how the market's behaving, why it's behaving the way that it's behaving. So first, I'm going to go through a few quick charts, some of the bigger companies, and then we'll talk about the political risks and what's going on, because that's what a lot of news is covering. But I'm going to go into it as far as a retail trader is concerned, or what you should be watching out for as you're trading on this market, or what you could potentially expect. Obviously, there's two outcomes. Market can go down or market can go up or go sideways, but it's going to either go down or up depending on who wins and depending on the political risk. So looking at this right now, let's just go through some charts. I have Facebook here that had some earnings. If you look at this, we're having a major sell-off. Overall, the market is acting weak, and this one is having a nice sell-off from those highs simply due to earnings, the words that they used, and this happens. And for me, it wouldn't be a surprise for this stock to really come back down if you take this stock and the run that it's had, I wouldn't be surprised if it came down to 88 or even 75. Because look at that run and expansion. So what could happen? Well, if you did an A to B, B to C pattern, you could say, okay, well, this is A to B, and we could have a B to C and then a C to D into higher legs. So a pullback could happen. Is it likely? Maybe, maybe not. I don't know. We're going to see. This is just the first day after earnings, but you can see it's really having a problem within the stock. And of course, overall market conditions could continue to accelerate that stock even further. So you want to pay close attention to how a lot of things are moving, not just one thing. Okay, you're not just looking at just one individual thing, but how overall everything is moving, and that'll give you a bigger picture of the market. If you take a look at Amazon, the same concept with earnings. These things have to be nearly perfect earnings, and if they don't, I talked about this rolling action in the critical charts. And you can see we had this 40-point sell-off, and then we had a little pop. I thought we would get the pop all the way up to this price level and then roll over just to fill the gap, but we didn't get there, so we just got up a little bit, and now we continue to roll over, again, due to market conditions. If you look at this stock, where would I say is a good value? Maybe 675, somewhere around that price level. You can see that because of some of the swing points over here. So that's why I say, even coming into this 50-day moving average, you can kind of see that moving average right there. So coming back to there would be a pretty good value buy. I wouldn't chase it right now and try to catch it on the dip or anything like that, because you don't know how far it's going to pull back. Looking at Tesla, look at this one. This one is setting up for lower prices, especially if we break here. You could see some serious lower prices. There's your support points right there. Break here. Could take it, 150 price level at least, and then we'll see where it goes from there. But that's really pushing to the downward end, and it's kept trying to break it, and so far it hasn't. But if it does, you'll probably see it accelerate lower. Looking at Apple, this one is just acting a little weak, choppy. It's getting into that 120 price level, and it can't get above it. If you take these resistance lines all the way over, you can see that range right there. It's rejecting prices right at that price level right there. And, a good value for that stock would be somewhere around this price level. If it breaks that price level, it wouldn't surprise me to, take this stock even further, in the 80s, in the 70s or 60s. It's Apple. Yeah, people love it. But, for me personally, I don't really use their products. It's not my favorite kind of company that I deal business with, but the stock is loved. A lot of other people love the products. And yeah, you can't deny the revenue growth that it's had. But at this price point, in this juncture, that 120 is the problem. So if you can get above that 122 level, you might see, okay, that's a good price. Or if you get into this 92 price level and it bounces, you could say, okay, that could be a good value to get into the stock as well if you're looking for a longer term play. Okay, taking a look at Starbucks. I mentioned this one multiple times. For months, we've talked about this in the critical charts. So when we really look at it, this was our support. I mentioned it dozens of times. Breaking right there, breaking, volume picking up, market acting weak right now as I look through all these monitors and the charts. So this one, definitely I would expect further lower prices. If you look at the daily, you can see the way that it's playing. Broke it that first day, tried to get back above it, and then it couldn't do it. Follow through day, massive wide price spread for a stock like this. In general, it's not that much. It's $1.08, but for this type of stock, $1.08 is pretty big. So again, fear, selling action, worry, triangle pattern, overextension, just the way things move. If you look at, let's go Netflix first. Talked about this one also, critical charts. Those of you that are there, review the chart. Resistance level, why? Stock is overextended. How fast can you go? Are you going to be a rocket to the moon? Probably not. This one exploding like a rocket ship, right there after earnings. So you think it's going to break through? No, probably not. It's not real. It's not realistic. So you could see right there pulling back a bit. So could it pull back a little bit right here? go a little like this and then break through? Yeah, it could. It just takes a little bit of time. It's not going to do it all in one day, and that's why I said a little too far, too fast, too quick, right? So that's the thing. You want to be mindful of these explosive run-ups. Disney right here, similar to Starbucks. I'm watching this between the Starbucks and the Disney. If you look at it, setting up for lower prices. Not a good sign, because if this one breaks this level as well, that could send the market also going lower, because it's tied in a big way to these indices. So it's tied into the Dow Jones, the S&P, and so forth. It's tied in pretty big way. Same with if we look here at the Nike. You can see, again, this one, breaking these levels, these key stocks breaking these levels, which is fueling this market. And then CMG, again, mentioned in the critical charts. This one, just horrible. It's been moving. This stock is toast. I would expect this stock on a projected move from here, 360, and then going down to about another 360, putting it into the 200 price level, 230, we'll see what happens. I mean, you might get some value buyers stepping in 280, 285, 240, but somewhere in the 200s is probably where it's going to go. If you look at it right there, I mean, now we're clearing this next level, coming into maybe 250, 240. So this one, I'd step aside. It's just too much volume. If you really look at it, too much heavy volume right there. Picking up into that stock. It's just way too much. Okay, so that's what I'm looking at on these charts. Now let's look at the indices and protecting yourself, and looking at preparing for the uncertainty and the risk. I've talked about the political side of things in my critical lessons in the past. I've also mentioned it about Trading Politics, episode 104. A lot of people were not happy with this episode just because of their political views. For me, it's irrelevant. It doesn't matter what your political views are, because I'm looking at the market, the way it behaves, the way it reacts, and statistical probabilities. I'm looking at numbers specifically, right? What's going to happen, what's happening, not about the issues. You can vote whatever way you want. Point here is looking at Trading Politics. If you review that video, you'll know that I've spent a great deal of energy looking at the statistical chance or the probabilities of the markets. Democrats typically do better in economic situations. That's just the numbers and figures. You can go out, do your own statistics, and research that on the Economic Bureau of Statistics. So just go ahead and break apart some of the charts, indices, and so forth. But in general, the market doesn't like volatility. That's the simple point behind it. When things are more volatile, unexpected, unsure of what's going to happen, the market's going to sell off. So when you look at the S&P and what's been going on, I've mentioned that regardless of the candidate, I expected a slight sell-off. I just would expect a larger sell-off if Trump gets elected. So looking at this, I've mentioned that we're already at toppy levels, right? We're at kind of at all-time highs. If you look at this, you can see this kind of rounding action right there. So what happened here and what was going on? Well, right around this price level and right around this time, I mean, there was, of course, a few different actions. There was the Federal Reserve that was also coming in. There was that oil pipeline that burst. So there's a few things that have been happening. But in general, Trump took the lead in some of the polls. Things have been getting a little more even on the political front. So when this happened, right here, the market started to see this and started to sell off more and more. And that, of course, as you know, as a snowball effect, that continues to accelerate things. So when this starts to accelerate things, it continues to move and move. And as you break critical levels, like right here, where we're breaking these critical points, that continues to accelerate it even further, because now people step in, not just getting out of positions, but now they're thinking, well, maybe I should just short the stocks, and instead, rather than just be in cash, they'll actually go in and short it. So that continues to create further selling action. You can see the volume there picking up. And, we're going to have this political headwind until the election. Now, there's economists that project that we'll probably get a 5 to 10% correction if Trump gets elected. So the next day, market will sell off. So anybody who has 401ks, 403bs, all those retirement packages that you basically have with your employer, pretend that you're going to get a pay cut if Trump gets elected. That's what the economists say. If you look at it, a 5% from here, if we draw it down, would put us down about 105 points. That's from here. If we continue to go lower, and 5% from there could put us right at the 1980 price level. Could it happen? Absolutely. We were just at the 2000s during Brexit, and that wasn't even our country, right? So if you really back check some things, we can really get into this 1865 level. And why is that? Well, again, I mentioned that it's due to uncertainty with a character and behavior that's a little more volatile with unpredictability. The market doesn't like predictability or unpredictability. So just like when you have the Fed Reserve, when they're looking at, okay, we'll probably raise interest rates, they're telegraphing things, right? But with Trump, you can't really telegraph. You can't see what's going on. And that's why people are worried. The market itself feels that with a Hillary Clinton, there's a more even pace to what's going to happen. There's more calmness to it. Of course, there's these email scandals. Of course, there's Trump scandals. There's scandals all over the place. But as far as the character, the personality, the policies, the market overall is more worried if Trump gets elected. So with that in mind, if we look at the markets, we were already at a top level or a little bit higher prices. So again, I reemphasize what I mentioned earlier is that if he gets elected, I would expect a pullback. Would I expect a 5 to 10% pullback like some people say? It wouldn't surprise me. It wouldn't surprise me. So for me, I'm a little more cautious on my positions, a little bit lighter on my positions, a little more positioned for the short side. But what you also need to be mindful is that if you get some unexpected result, if you get something that's euphoric to the market, maybe let's just say Hillary Clinton wins, you could get a massive pop as well, and that way it could change your risk profile picture. Meaning, if you're positioned for the short side and all of a sudden Hillary Clinton wins, you need to be very quick to change your positions, because if the market skyrockets, all of a sudden, boom, your positions could be in deep trouble, especially on the short side. So in this scenario, in this situation, you basically have to be prepared for a double direction move. You don't know whether Trump is going to move the markets to the upside, whether Trump's going to move it to the downside, whether Hillary's going to move it to the upside, whether it's to the downside. Regardless, we have more volatility because there's uncertainty. So what do you do in this situation? Well, you can do one of two things. The first thing that you can do is pretty much lighten up on your positions. You can go in cash. The second thing that you can do is you can be lighter on your short side. So if you have a lot of positions, let's say to the upside, what you could do is naturally neutralize some of those positions. So for example, if you have, let's pretend you just bought the S&P 500 and you bought it somewhere over here or even over here. It doesn't matter where you bought it, but you're positioned long, let's say 500 shares. So what can you do? Well, what you could do is take a look at something like the SDS, which works really well when stocks go down. You can see this has been climbing to the upside, and you can buy it for a hedge just for a couple of days, right? During the election, after the election results, that's what you could ultimately do. There's other vehicles like a TZA, so this is another vehicle that you could do, but you could see this is the small cap 3x bear ETF. These you typically do not hold for a long time. These are hedging vehicles because they get recalibrated. So if you really look at it, it's been heading lower, right? Market's been heading higher. They get recalibrated. You can also see the stock splits right here that take effect. So in general, these are not things you trade for a long period of time. They are basically, you look at a move and you say, okay, there's fear coming in the market. You get into it right here, maybe hold it for a week or two, and then you get out, right? That's all they're all about. You get into it right here, fear is coming in, just in case, right there, and then you're out. Okay, that's what you do with these types of vehicles. There's TZA, there's SDS, there's a lot of bear cap vehicles. You could do the VIXX or VIIX right here. This is the volatility. So in either case, these are the vehicles that you're looking for. But again, these are a hedge for a small period of time. These are not for long-term holdings. And the whole point behind this is when you look at the SPX right now, we're probably going to get into this price level right there, which that price level will be right around 2040, give or take a few points. So if we get into this price level right here, or if Trump gets elected, you'll probably see it come down to test this. If it breaks through, probably come to test the 2000. If it breaks this, now you start looking into some other previous points, okay? With Hillary, I still would expect a slight sell-off. It's just probably going to be a little bit less. And that is in part still due to the overwhelming top levels that we've had in the market. I'd still expect maybe 1 or 2 day pullback, but you might see a rally to the upside after a few days. So that's kind of what I'm looking at as far as the political risks. So ultimately, you need to look at the hedging possibilities of what if this goes against you, rather than looking at how much money you can make or the political outcome. If you're looking at it from an economic standpoint, you're looking at it in terms of what if this goes against me? What is the uncertainty? Because that's what people are looking at. That's what are the risks? You're looking at the risks on the table, and that's what investors talk about, because the risks on the table right now is these more or less political risks. And as you continue to get closer and closer to the election, polling numbers come out, and the market continues to go down. If we start coming into this level and there's some kind of nervousness in the marketplace that happens, all of a sudden 5% to 10% from this level becomes a much larger and a bigger deal. So from here, if you look at a 5, 6%, 7% correction, 10% would bring us back into 1833. So that would put us back right here to about 1860, because that's where you'll probably get some support. Can it happen? No question about it. Simply because, take a look at some of these bars right here. Probably won't happen in a day, just like the sell-off here hasn't been in a day, but it can happen. It could happen right here, just like we had a massive 40-point down day, and then it comes back up a bit, go down again, come back up a bit. Same thing right now. We've had massive multiple day sell-off simply due to the uncertainty, simply due to the risk. That's what's on the table. You're always watching, what if it goes against me? And right now, that's what you have. You have uncertainty, you have risk, and you need to hedge for it. Or you simply don't trade, wait till after the election, things will stabilize a little bit, and now you have a little bit more stable environment. So those are some of the major big risks. And the reason for that is you're also looking at the VIX, because as you start looking at a VIX above 20, that's some serious nervousness in the market. When you have a VIX above 20, you can see the last time this really happened was right here at pretty much the Brexit levels or previous sell-offs. What is it? September, October. Mid-September, you also have some right here at the 16 level. But ultimately, here you had some nervousness. Here you have some nervousness. So again, out of the last year, we haven't had too many extremely high VIX levels, but now we're starting to get there. And we could get into the 30s if more nervousness, panic selling starts kicking in, and all the retail traders who basically have the 401ks, 403bs, they could take a pay cut on their retirement. But ultimately, that's what I'm looking at in the economic sense. What am I doing? I'm setting up, selling some calls on the upper side at this price level right around here. So that way, theta decay also works against me, because there's 14 days in the November option, so you could sell some premium around this level. So more than likely, that's going to expire. It allows me to hedge for some of the upside positions that I have rather than taking them off. Of course, I'm pairing some positions, but in general, I'm hedging in case there's a major down risk that comes down either to this 1850 level or even 1750. I mean, I don't see that 1750 would happen. I'd say you're more likely to get into the 1850 price level right here, 1860, and then time will tell. But you do have a few support levels before there, like the 2040, to the 2000s, obviously, and the 1900 or the 1860. So watching those levels, that's ultimately what you're looking at in these stocks. And if you watch all of these other stocks, if you start seeing Disney breaking down, Nike breaking down, as which you can see what's happening, Starbucks also, if that starts to accelerate, simply because it's just, the second to third day on breaking on these stocks. But if you see all of these things start breaking together, and they're starting to move, and then Netflix starts to pull back to the hundreds, Apple starts to pull back into the 90s, you have an event where many things are working together to really go against the market. And that's really where ultimately you get some massive selling, and it creates a lot of buying opportunities as well. Because as you look at the IWM and you start seeing the overall market picture, we're also got into the highs and then we're rolling over. If you take a look at the composite on the NASDAQ, the same thing. We were at all-time highs, rolling over. Wilshire 5000, same thing. Getting into those highs, into the toppy levels, and now we're rolling over as well. So in part, the market was just overbought, a little too high, too toppy. But that also means any little uncertainty, any little jitter, anything that's a little volatile, a little crazy, is going to move this market in a panic way and panic selling. And that's ultimately what you're seeing right now when it comes to this market, and why we've had so many of these days. 55 points within the last, 9 to 10 days. So fairly good runoff, but it's a little calm right now, but it's just selling, slight selling, getting out, being careful. That's what's happening. If there's nervousness, major panic that comes in, you'll probably see one big, massive bar like this. So I don't want to scare you, because, it may not happen, but that's what people are preparing for, is that if obviously the Trump gets elected, that's what they're worried about, is that there could be massive catastrophic problems within the economy, because that's what he's about. He's about disrupting things, and that's what may happen. So you're watching the market, you're watching the risks, taking a look at some of these stocks that we covered. They're going to create great buying opportunities, just like with Facebook, especially if it comes down to 75, 60, 85. Be great buying points. I mean, it's just the first day. Same thing with Amazon. If it gets into, let's say, 680, it's going to be a nice buying opportunity. So allow those setups to set up. So for you being an active trader, you're going to have nice setups if those things come back and pull back. But if not, then by all means, you'll still get that bounce probably, and then things will keep moving. So we'll see how things play out. Nobody really knows on the election. The polls aren't always accurate. So you never really know. But as far as economics go, when the market's more nervous, when there's more volatility, when there's a potential increase in volatility, then the market obviously sells off, because there's that uncertainty and the risk. And you need to hedge it by either, number one, reducing your position, number two, hedging it in some way, which is getting either the SDS, the TZA, or some kind of bear fund, or the VIIX, or sell some upside options to hedge for a potential down move. And the same thing goes in reverse. If you're looking for, let's just say we went down 200-300 points in the last week or so, you do the same thing in the opposite way for a long position. If the market just keeps selling, it's probably going to bounce soon or with time. You can't have that super emotional mindset when it comes to the market. You need to be clear-minded. You need to think out things logically, realistic scenarios, situations, and just look at it on a what's possible, what's your risks, what can happen, what may happen, and what's the distance or spread of that movement in a situation. All right, so thanks for joining me in this video lesson. If you want to see some of the courses that I have available, including that options course that I mentioned earlier, go ahead and click this button right here and you'll be taken to that courses page. But if you want to go ahead and watch some other training videos and some other market recaps, then click this thumbnail right here and you'll continue watching and learning with me. In the end, remember, there's more to life than money. Go out, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.